Namaste to all. I welcome you all on this another very important discussion on one of the very important topic of accounting aspect of employee benefits. Employees, if I talk about, there have been a huge discussion that whether if we are allowed to value the employees, I would say, value and treat it as an intangible asset, because recognizing that as an intangible asset. And there have been for and against for that. And of course, now we have got standards that, of course, a self-generated asset we cannot value. But that employee at many places, in fact, I would say all places, whether it is manufacturing, whether it is services, whether it is software, any field it is very important resource for any entity. So how to account for it? Various benefits, various we talk about benefits in common parlance, say expense on employees. But yes, it is employee benefits, whether it is short term, whether it is long term, how to account for, when to account for, allowability under income tax, non-allowability under income tax, valuation, actuarial, so many things. We do what is to company, what is to a non-corporate, so many things are there. So it is a very important aspect of accounting. And for that, today we have got two very prominent panelists to discuss over that, which is CA Siddharth Ayerji, who has got more than 19 years of international experience, who is an of course, apart from CA, he has got huge experience in the IFRS, US GAAP, Ind AS, IPOs, capital reserves, statutory audits, industry experience he has got. Of course, he has been a regular contributor to the institute in the ASB, in our Ind AS course also. So, Ayar Sahab, I welcome you and thanks for joining us and sharing your knowledge into this.
My privilege.
And another panelist which we have is CA Karthikeya Kandoi. Welcome, Karthikeya. Again, a very prominent chartered accountant who, apart from chartered accountants, he is more prominently known for his actuarial. So he's an actuary. So a chartered accountant doing actuary, and he's into the board of IAI also, giving regular consultancy to them. Of course, a regular speaker for our Ind AS certification course. Welcome, Karthikeya Kandoi, for joining today. And thanks both of the panelists for sharing your knowledge and wisdom with all the members at large. And to moderate these two, we have got another stalwart, I would say, CA Chandni Gupta, an author on the Ind AS subject, having a deep knowledge into the industry. Really, I am hoping and I'm very sure that this discussion today would be very fruitful and very beneficial for members at large in the times to come. So my best wishes, and let us start this, and over to Chandni ji for the same.
Thank you, sir. A very good evening to all the participants who have joined, and respected chairman of the ASB and the entire board team, Shalini ma'am, and our two speakers on the panel. We are going to start this session, which is on Ind AS 19. And mostly we will discuss not just Ind AS, but the entire accounting parlance on employee benefits.
Chandni ji, it is not only Ind AS 19, but AS 15 also.
Yes. So, yes, of course, because we are living in a country where we have multiple sets of gaps, right? And the dynamics change with every accounting guidance. And as sir has mentioned, that employees are one of the most valuable assets, even though we do not recognize them in the balance sheet, but they are one of the most valuable assets of any company, and it's imperative we understand that how to recognize the cost associated or the benefits associated with them, right? So as sir has also mentioned, that we are very hopeful this session is going to be very fruitful to all, and this will be on the record at ICI's website. So whoever has missed this session can refer it later on, right? So let's get started with our session. So my first question, we want to understand that what are all the accounting guidance available in India around employee benefits, right? Because uh, as we just mentioned that there are multiple set of gaps in India, and not every company follows all the gaps, right? There are specific applicabilities and all of that. So we want to understand this dynamic first, and then maybe we can get ahead with the technical part. So I request Siddharth sir to answer this question.
Yeah, hi. Good evening, everyone. Good evening, Chandni. It'll be a privilege, to be part of this session. So, regarding your question on, which are the accounting guidances available, in India, with respect to employee benefits. So, at a very high level, I would say that, AS 15, basically under Indian GAAP, provides guidance on how to account for employee benefits, while Ind AS 19 provides guidance, on how to account for employee benefits. Ind AS 19 is, very much in line with the global IFRS accounting standards. And so companies, which sometimes report under Ind AS as well as IFRS, will not have too much of gap differences. Other than that, some companies may also be reporting in the US gap, which is not the subject matter, which under discussion today. So basically, I would say AS 15 and Ind AS 19 are the two standards which deals with employee benefits. Again, AS 15 and Ind AS 19 are fairly similar to each other, substantially the same, but there are key differences still between the two sets of standards. One of them would be basically with respect to actual gains and losses with respect to post retirement benefit plans. So basically, under Ind AS, actual gains and losses, or the remeasurement gains and losses, that is as it is called, but for the sake of simplicity, I'll call it as actual gains and losses, are recognized in other comprehensive income, and they are not reclassified to the income statement. You could move it within various line items of the reserves, but it does not go to the income statement. And under Indian GAAP, actual gains and losses are immediately recorded in the statement of profit and loss account. That is one basic free difference, between AS 15 and Ind AS 19. What would be the impact of this? The volatility in the P&L under Ind AS is likely to reduce, because the actual gains and losses are now being recorded in other comprehensive income, vis-a-vis Indian GAAP, where it needs to be recorded in the statement of profit and loss account. The second is, typically, while theoretically it could be called a difference, but I don't think, in a practical scenario it ever applies, is the frequency of actuarial valuation. So under Ind AS, employers, typically remeasure the defined benefit obligation at each reporting date to determine the balance sheet and the OCI component. Ind AS does not provide for a practical expedient to use a measurement date other than the end of the fiscal or the interim period date. So what we have seen, companies following Ind AS is at least annually they are required to do a actual valuation. While under Indian GAAP, that practically it is done annually. There is some leeway where it says you could do it in a period of once in 3 years. And however, there are any material transactions between the last valuation date and the current year-end date, you would need to give the impact of that. But the actual valuation should not exceed a period of more than 3 years. But practically, what we have seen when we are auditing companies, etc., is that even under Indian GAAP, the valuation is done minimum, once in a year. While what we see under Ind AS is, if you are doing an audit on a quarterly basis, companies do an actual valuation. Many companies do an actual valuation on a quarterly basis. While if you are doing a limited review, especially for listed entities on a quarterly basis, that is a mixed practice. Some companies do it on a quarterly basis, while some companies do it on an annual basis. Another difference, between Indian GAAP and Ind AS is with respect to, past service cost. Under Indian GAAP, it is generally recognized on a straight line basis over the vesting period if it is not vested. If the past service cost is already vested, it is recognized immediately. While under Ind AS, past service cost is required to be recorded immediately. So this is, the major differences between Indian GAAP and Ind AS with respect to employee benefits. There could be certain other minor differences, including some relating to disclosures, etc. But this would, be helpful, for a person to understand in terms of what could be the difference between Indian GAAP and Ind AS with respect to employee benefits. What we also need to cover is, while it may not be specifically given in any particular standard, some other transactions, could include employee share-based payments, for example, or a business combination transaction. So very often, what we have seen is, in a business combination, if company A acquires company B, there is an earnout type payments, in the uh, agreement between company A and company B, wherein the promoter of company A or a promoter of company B, because company B is being acquired, is required to be paid X amount over a period of 3 years after the date of acquisition, and the promoter of company B is required to be in continuing employment with company A for a period of 3 years. This, while it may look to be a part of Ind AS 103, could technically be part of Ind AS 19 and may need to be accounted for as per the requirement of Ind AS 19. We have seen, people miss this out and put it as a part of purchase consideration and record a goodwill for this, but it could be inappropriate. It will have to be evaluated. So if there's a service condition attached in any other agreement, that will need to be covered as a part of Ind AS 19 and not any other standard. Yeah, yes, Annie.
Right. So thank you so much, sir, for such a detailed explanation on this particular question, because at times we kind of miss what is happening in practical scenario, what companies are actually following. But yes, sir has covered that what companies are doing and where we tend to miss. Right. So all in all, it is to say that we have Ind AS 19 for companies which are applying Ind AS, and AS 15 for companies which are following accounting standards, right? So, okay, moving on to the next question. We are today here to discuss accounting for employee benefits. So, I think it's very, very important to understand what is employee, who is an employee, right? And how is it covered under these standards? Who all employees will be covered under this particular standards that we are talking about, right? So my question again to you, Siddharth sir, if you can just help us understand what is the definition of an employee, and because we see that a lot of companies have are hiring people on contract basis or say temporary basis, so will they also be covered in this standard?
Very good question, Chandni. As you said, it's very important to know who an employee is, because that will be governed by the requirement of Ind AS 19. And if he doesn't meet the definition of an employee, then a different standard, probably, Ind AS 37 could apply, with respect to obligations. If not Ind AS 37, probably, there's a remote possibility that Ind AS 102 or share-based payments could apply. So identification of an employee is very important. However, the funny part is that employee has not really been defined in the standard. So what do you do? So para 7 of Ind AS 19 provides that employee may provide services on a full-time, part-time, permanent, or casual or a temporary basis. So it says that the employee could be providing services on a full-time, part-time, permanent, casual, or temporary purpose. The essence is that the term employee is intended to apply widely, and need not be that there should be a contract of employment for a person to be considered to be an employee, because generally, as you said, temporary staff or casual labor may not have a contract of employment. So basically we need to basically understand the crux, and it could involve a lot of judgment in determining who the employee is. So the following probably indicators may help to understand whether an employee relationship exists with a client, with a company or not. A contract of employment, yes, invariably an employee relationship must exist. If the services are to be performed by a particular individual and that individual has no discretion to arrange for somebody else to do his job. So if Mr. A has to do the job and Mr. A cannot delegate it to Mr. B or Mr. C, then in a more likely scenario, he is likely to be an employee. If there is a large amount of oversight and direction by the entity over that particular individual, then in that case it is likely that basically employee relationship may exist. Then necessary tools, equipments, materials are provided by the entity. Then in that case, it could potentially be that relationship would be governed by the requirements of Ind AS 19. Individuals who are paid on a time basis rather than on a project or fixed basis, potentially, there could be an employee relationship. So, not defined, but these are the indicators given in the standard and the literature which is generally available widely to determine whether an employee is covered under, whether a relationship is covered under the definition of an employee, and therefore Ind AS 19 applies or not.
Right, because what I understand is there are a lot of companies which are now going, which are associating consultants as well,
Yes.
on a contract basis. So it's imperative to understand that whether they are employees or not,
Yes,
right? Because
yes.
that there is a service
Yes.
that is being given by a person, but
Yes.
that may not be an employee.
Yeah. So in many companies, especially manufacturing companies, we have seen
Right.
contract laborers, somewhere in the agreement with the service provider, the gratuity, etc., liability could potentially fall on the company which is employing the contract labor. So it is highly judgmental, who is an employee, and because the standard does not give a particular clear definition,
Explanation.
it
Right.
needs to be evaluated based on the factors that I just discussed to see whether an
Right.
employment relationship exists or not.
Right. Absolutely. So that definitely helps. Okay. So
Yeah, so to add further in this, in fact, the directors are also included in this valuation, like whatever
Okay.
directors remuneration we pay, on that also we need to consider as an employee.
Agreed.
okay, yeah, that information definitely helps, because a lot of companies, or we as consultants, need to keep a tab on that. Companies may miss that part as well. Right. So now that we know, that we understand who our employees would be, we need to understand what all benefits these companies are giving to those employees, and what will be covered in these standards, what benefits will not be covered in the standard, and what are the various types of benefits, so that we can understand the accounting later on.
Yeah. So the meaning of employee benefit, is the same under Ind AS 19 and AS 15. Employee benefits primarily means all forms of consideration, apart from share-based payments, which are dealt with, by a different standard, Ind AS 102, and a guidance note on share-based payments for Indian GAAP, given by an employer in exchange for services rendered by the employees of a termination of employment. In particular, I would say that employee benefits would include, short-term benefits, which would include, wages, salaries, annual leave, annual bonuses, sometimes benefits in kinds. It could include, post-employment benefits, it would be pensions, gratuity, etc. Other long-term employee benefits, it would include long service leave, long service disability benefits, sometimes, deferred compensation of long-term bonuses, where you're paid bonuses, based on 3 years or 5 years cumulative revenue targets, EBITDA targets, etc. Those also get covered under the purview of Ind AS 19 as an employee benefit. And termination benefits, which are provided in exchange of termination of an employee's employment, are also covered, under the requirements of the standard. And as I said, sometimes it could be
I think there is some technical glitch.
Yeah, so continue on this. So
Yeah.
like we have the termination benefits which are paid on the termination of employee. For example, the VRS scheme, voluntary retirement scheme, or let's say a company is doing some restructuring. So as part of restructuring, they are paying some compensation to the employees. So that part is also covered under the Ind AS 19 along with the Ind AS 37, where 37 speaks about the restructuring cost, but the employee compensation part on the termination is captured under the Ind AS 19.
Ind AS 19.
Yeah.
Okay, so sir, as Siddharth sir was explaining that there are various types of benefits, say short-term benefits, then post-employment benefits, other long-term benefits, and then he mentioned about the termination benefits. So to start with, let's understand what are short-term benefits
Connection
and
in
how
between.
the accounting will go. Yeah, that's all right. I think Karthikeya sir pitched in that
Thank you.
he covered that part.
Yeah, so basically the short-term benefits, as the name suggests, they are the short-term. So basically the standard says any benefits which are paid within the short-term, or you can say 12 months from the reporting date. The examples could be like your paid leave, which is, let's say, not allowed to be carry forwarded, your regular salary payments, your annual bonuses, or it can be non-monetary item, for example, the medical care facility provided by the company, or let's say your annual group medical plan, where we pay the annual medical premium of our active staffs. So basically any benefit payments which are paid during our service period and which will be settled within the 12 months from the reporting date. So they are called as a short-term employee benefits.
So in the short-term employee benefits, you gave certain examples like salaries, wages, paid leaves. So the part related to leaves get a bit complex, I think. So can you just explain a little bit more about these leave accounting and how there can be different types of leaves?
Yeah. So let's say we can discuss this with an example of the company leave policy. Let's say company grants 7 days of sick leave, and employee can utilize this 7 days of sick leave in the particular year. Otherwise, they are allowed to carry forward in the next year. But in the next year, if they don't consume it, it will lapse. So this is a type of example where carry forward is allowed only for the short term, which is the 12 months period. So this type of leave is called as a accumulating leave, where we are allowed to accumulate the leave. But there can be different type of leave policy where company don't allow to accumulate the leaves. For example, they will tell the employees are required to consume the leave within the same year, or that will encash at the end of the year. Like there is no carry forward beyond the reporting period. So they are called as a non-accumulating leaves. So while the accounting is different for accumulating leave and non-accumulating leave. In case of non-accumulating leaves, the standard says we need to account for such non-accumulating leaves when the absence occur. What are the other examples of non-accumulating leave? Could be the maternity leave or paternity leave, because they cannot be carry forwarded. They are paid as a benefit to the members whenever they consume this kind of leaves. So they are accounted for as an expense whenever we consume the benefit, and there is no provision being made in the advance. But coming to the accumulated leave, as the name suggests, we are accumulating the leave. So we have to make the provision. Now, accumulating leaves can be two types. What we discussed for the sick leave, where we don't allow the encashment. We are telling the employee you have to consume the leave within the next year. So this is a leave where it is only consumption being allowed. So this is called as a non-vesting accumulated leaves as per the standard, where the encashment of leave is not allowed. Other type of leave within the accumulating leave is the encashable leave, let's say, where company will tell, okay, next year you don't consume the leave, we will encash you at the end of the next year. So that encashable leave, the technical word in the standard is the vesting accumulating leave. So now standard says you need to make the provision for such short-term leaves for both accumulating leaves under the vesting as well as non-vesting. So it doesn't matter whether we encash the leave or not, we have to make the provision. The rationale being, in case of encashment of leave, the outflow from company is the encashment payout. Let's say you encash the leave on the basic salary and you have, let's say, 15 days of leave. So expected payout on account of those 15 days of leave will be your provision. But let's say you are not allowed to encash the leave, but you are allowed to consume the leave. So when we consume the leave, we get the full salary. So that's why standard says whatever leaves we are going to utilize from this balance. For that, we need to make the provision, and this provision will be made as per the CTC salary, because there is a confusion in the stakeholders. Sometimes they create the provision for such accumulating leaves on the basic salary, but for the consumption part, it is the CTC salary. But for the encashment part, we need to go back to company leave policy, because X company will have a leave policy of basic salary, Y company may have a leave policy of gross salary. So that encashment will depend on our company policy.
Okay.
Yeah, so this is all about from the short-term side. So on the other hand, we will have the long-term leave, because let's say any leave which is not allowed to carry forward beyond, like, or you can say which is allowed to carry forward beyond 12 months. Like there's no lapsation at the end of year one. It can be allowed to carry forward. So it is called as a other long-term leave, and that other long-term leave requires the actuarial valuation provision.
Right. So basically, for the differentiation has to be done between the accumulating leaves and non-accumulating leaves, and it will mostly depend upon the contract and company policies, right?
Right.
And accordingly, the accounting has to be done, right? So what we understand is there are certain companies which are on profit sharing, and also some companies who have which have complex bonus plans. So how to account for profit sharing and bonus plans?
Yeah, so what happens, these kind of plans are also captured and covered under the short-term employee benefits. So for accounting for short-term employee benefits, standard says we need to make the provision and account for the expense for the amount which we expected to pay. So we need to calculate based on the management expectation, what is the best estimate of amount which we are expected to pay. Further, the standard says that discounting is not required for this kind of benefit, and other actuarial assumptions are not required, because standard further keeps on talking about the various actuarial assumptions. But for this kind of particular plans, which are short-term in nature, the actuarial assumptions and actuarial valuation is not required. The accounting is quite simple as compared to post-employment plan, and only thing we need to make the provision what we expect to pay. But sometimes what happens, companies may have a bonus plan which is staggered. For example, company announces you a bonus of, let's say, 2 lakh rupees, but they tell the payment will happen in 2 parts or 3 parts in a year. Then it will go to other long-term benefit. Right. So that will attract the different provisions and requires the actuarial valuation when we move to other long-term.
Right. So basically, the provisions will vary from company to company basis their plans, and for all the short-term benefits, I think the accounting is pretty simpler. That whatever you are expecting to pay out, for that you have to make the provision. But as soon as we get into the long-term part, as we discussed the staggered bonus, like where companies are giving deferred bonuses. In that case, it goes to the long-term benefit. And is the actuarial valuation required in that case?
Yes, actuarial valuation is required for that plans.
Okay. So basically, all the companies need to evaluate their plans and understand that what their policy is asking for, and differentiate as per the standards, right? Right. So that is pretty clear. Now, I think let's move to the post-employment benefits, because we understand that part is a bit complex. So I request Siddharth sir to help us understand post-employment benefits, and we understand that there are defined contribution plans, defined benefit plans, and all of that. So if you can just differentiate and help us.
Yeah, Chandni. So as you rightly said, post-employment benefits are probably the most complex, in terms of accounting for employee benefits. So basically, post-employment benefits are employee benefits that are payable after completion of employment. Means they're not generally paid during employment. So they could be paid at a time of, say, retirement, or when an employee resigns and leaves the organizations. Some examples of post-employment benefits could be pensions, lump sum payments made on retirement, medical benefits that are paid after employment, etc. Post-employment plans, are classified as either defined contribution or defined benefit plans. And also the post-employment plans need not be a formal arrangement. They could have informal practices, or which could lead to a constructive obligation, which will get covered under Ind AS 19 because they are employees. Therefore, regardless of whether there is a legal requirement, it is a constructive requirement also, and you're making certain payments to certain employees after he retires. That will also be covered as a part of post-employment benefit plans. So post-employment benefits plans, as you rightly said, can be either a defined contribution plan or a defined benefit plan. So it's a defined contribution plan. If you make a fixed contribution into a separate entity or a fund, generally a fund, and there's no further obligation on the company, legal or constructive, to pay further amounts if the fund has insufficient assets to pay the employees for the current and prior services. So a typical example of, that means you make the payment, he renders the service, you make the payment to a fund, and you have no other obligation after you make this payment to pay the fund anything else. So a typical example of a defined contribution plan would be basically, when you contribute to a government provident fund. So that would typically fall as a defined contribution plan, because each year or each month, you will contribute a specific amount, to the government fund, and you have no obligation, subsequently once that contribution is made. So that will be a typical example of a defined contribution plan. All other post-employment benefit plans, which are basically not defined contribution plans, are defined benefit plans. So what's the difference between a defined benefit and a defined contribution is that under defined benefit plans, the employer's obligation is not limited to the amount that it agrees to contribute to a fund. So, if there's a shortfall or excess at the time when the fund is making the payment to the employee, say after his retirement, and the company is required to make good the shortfall, then that type of plans would typically fall under the definition of a defined benefit plan. So that is the most important feature. Some people get confused. Like in a provident fund, as I said, amount that is contributed to a government provident fund would generally, or would most probably would fall under the definition of a defined contribution plan. But if you have your own fund set up, like very large industry groups have their own provident fund set up, which is not a government fund, and you are making contribution towards that funds. If there's a shortfall, generally we are seeing never there will not be a shortfall. But if there is a shortfall, there is either a legal or a constructive obligation, for the company to make good the shortfall. The interest rates goes down significantly, and you are basically saying to the employee that you will get 8% or 9% interest on the amounts contributed, but the interest rates fall down significantly, therefore the fund has insufficient balance. So you as a company will basically fund or make additional contributions to that fund, so that the fund is able to make payments to the employees or when they retire. So that is a basic difference between a defined contribution and a defined benefit. On a defined contribution, once you make the contribution, you have no other obligation. While in a defined benefit, there could be a potential obligation that will arise at the time of making the when the fund makes the payment to the employees on their retirement, and you may have to make good of that. So that is the differentiating factor. And where we are seeing people miss out is, like as I said, with respect to provident funds, which are set up by the company itself, which is technically a defined benefit plan.
Benefit plan. Right. Yeah. Thank you, sir, for explaining this and clearly distinguishing between these two different types of plans, because the accounting varies significantly for these two types of plans, right? So now, for defined contribution plans, where the companies have to contribute, say, a percentage, and they do not have further obligation once they contribute their part, right? So what is the recognition and measurement criteria for these kind of plans, and how the accounting goes?
Yeah, so basically defined contribution plan accounting is basically very simple. an employee accounts for the contribution to the plan on an accrual basis. Therefore, when an employee has rendered the service during a period, the employer would recognize the contribution payable to the defined contribution plan in exchange for the service as a liability and an expense. So basically, whenever you render the service, you make an accrual and create a liability and pay off the liability. And that expense, will generally be to the P&L unless, another standard requires it to be capitalized. If it is the employee is working for a factory which is being set up, and therefore, you can capitalize that cost for this, then that cost will go as a part of my CWIP.
Right.
So accounting is very simple. So if you're required to contribute, say, 1,000 rupees in a year or in a month, and you contributed only 800, or you paid 800 rupees that particular month. So basically, the charge to the P&L will be 1,000 rupees. You paid 800 rupees, and 200 rupees would be a liability which you will need to pay in the near future. So pretty simple, no need for an actuarial valuation, etc., for a defined contribution plan.
Right. So that helps. Now, on the defined benefit obligations, I think this is this attracts more complex accounting as far as we understand. So I request Karthik sir to help us understand the accounting part.
Yeah, so if we speak on the defined benefit plans, the fundamental remains same. The accounting principle remains same. The accounting principle says we need to book any expense when the service is rendered. So this is the fundamental principle. The question is how to measure the obligation. So the measurement part, the standard says it has to be done as per the actuarial valuation method, and the method which is prescribed is the projected unit credit method. Because in actuarial science, we have 4 different methods with different 4 objectives. But the projected unit credit method, which is also known as a PUCM, it is known as for the accrual basis principal method out of those 4 methods in the actuarial science. So that's why globally, this is the method which is picked up in the accounting standards for the measurement of the defined benefit plans. So basically, this requires setting up of various assumptions, and that we will discuss maybe in detail in some time about what are the type of assumptions. But basically, the measurement is done as per this PUCM method. The timing will be when you render the service, because accounting is done on the accrual basis, not on the cash basis, because the payment is done in the long term. For example, the gratuity. The gratuity payment is done at the time of separation. The pension payment is done after the employee leaves the service, they retire, we paid them for the lifetime. So payment is happening in the long-term period. So accounting is not on the cash basis, it is on the accrual basis in the period when service is rendered. But method will be the PUCM method, which is given under the actuarial science. Yes.
Right. So, because what we have noticed that small companies like say MSMEs or startups, they do not really understand the dynamics of these employee benefit plans, defined benefit plans, which are paid after the employment and all of that, and they do not really account for it altogether. They're like, we can account for it when we pay it, right? So it's imperative to understand that the accrual has to be taken for this, and accounting needs to be done during the employment service period and not just when it is paid out, right? So you mentioned gratuity. Now, gratuity attracts a lot of complexity. So we want to understand, we want to start from the very beginning, like what is gratuity and what is the applicability of it, and what all companies are required to pay gratuity to their employees. So if you can just briefly explain that.
Yeah, so basically I can say the Gratuity Act is a 50 years old act. It is Gratuity Act 1972, which says that all organizations, it is not just companies, it is all kind of organizations. The organization can be a proprietorship firm, partnership firm, LLP, company, listed company, unlisted company. So all organizations having number of employees 10 or more at any time. Then Gratuity Act will become applicable, and it is once applicable, lifetime applicable. So any point in time in your life cycle of the organization, we have employees 10 or more, it is applicable. So बोलते ना कि गले की घंटी बज गई. So it's like that. Once we reach the 10 employee count, it is applicable. Now comes how it is paid. The standard says it is to be paid based on the 5 years of the vesting requirement.
Okay.
Like if employee complete the continuous service of the 5 years period and then they separate from the company, then we are required to pay the gratuity. But in case of death or the permanent disability, the 5-year vesting criteria is relaxed. Then, like for example, in 2 years' time, death happens, we need to pay the gratuity. At the same time, we need to also understand that the word is separation. See, for example, let's say any employee is continuing after their age of, let's say 60, 65, 70, 80. Let's say they are continuing in the organization as an employee. Then also the gratuity meter will keep on running. Like for example, they started the service at the age of 40 and they are working till the age of 75. So your eligible service will be full from age 40 to the 75. Like PF usually stops in the organizations at the age 58 or 60. This is the usual practice we have seen. But in case of gratuity, it keeps on running till the time we are rendering the service.
Got it. So basically, it depends first of all on the number of employees in the organization. That's when the applicability comes into picture, right? 10 or more employees have to be there in the organization.
Yes.
So for example, a company has been set up during the year, right? And
Right.
it has 50 employees from the very beginning. But employees have not completed their 5 years yet because it's just got incorporated. So
Right.
in that case also, will the provisions apply?
Yeah, so on that, our accounting standard 15 as well as Ind AS 19, they are very specifically covered this aspect. So AS 15, we have para 770, which says that if we have any benefit which is not yet vested, like 5 years not yet completed, still we need to make the provision. So while making the provision, the calculation needs to allow for the probability that what is the chance that member will vest the benefit. For example, let's say you have completed the 1 year service, but you need to further complete 4 years of service. And let's say with the simple mathematics, you assume that 10% per annum is the chance of leaving the service by the employee in each year. So you will say 40% is the chance that employee will leave the organization. So only proportionate for 60% chance you will make the provision. This is I'm telling just from the simple mathematics.
Right.
The actual calculation is little bit more complex because it applies the conditional probabilities, the probability of death, etc. Various assumptions are there, but on a broad, simple mathematics, if we say that you are making 60% provision. And
Right.
one more myth I would like to clear around the Gratuity Act. Sometimes our friends in the company, they believe that the 20 lakh limit, which is in the gratuity, is given under the Income Tax Act. So Income Tax Act also have the 20 lakh limit, but it is an underlying limit in the Gratuity Act first. So for example, the employee have, let's say, high basic salary of, let's say, 5 lakh rupees. And based on the 15/26 calculation, it works out to, let's say, 30 lakh rupees at the end of the separation. So as a statutory liability, company is obliged to pay only 20 lakh rupees. They are not obliged to pay 30 lakhs. But at the same time, section 4, subsection 5 of the Gratuity Act says, if company wants, they can have the arrangement to pay higher benefits. So if company wants, they can pay 30 lakh rupees. But as a statutory obligation, the liability is only 20 lakhs. If they pay 30 lakhs, then 10 lakh will be taxable in the hands of employee. See why it is very important. While we make the provision, we need to discuss with the company whether their policy restricts up to 20 lakhs, which is the default Gratuity Act, you can say, or they have any specific provision under their HR policies or maybe some employee arrangement where they pay some other higher benefit scheme. So that's why it is important on that aspect.
Right. So basically for the gratuity part, even though it's not yet vested, even though 5 years have not been completed, the companies need to account for it, make the provision. And that's where I think the role of actuary comes into play, because they are the experts who give the information to the companies that this much amount of provision is needed. Right. So understanding the actuarial valuation and all of that, can you please explain how what is the applicability of actuarial valuation, and is every company required to do that valuation done, or is there any exception?
Yeah, so basically under the, see, as a company means, let's say private limited or the limited company and the listed company. Okay, so for the companies we have the accounting standards governed under the Companies Act, and they are given by the MCA basically. Okay, so they have also given some kind of relaxations under the accounting standards. So while you go through the relaxations which are given to the small companies, so they have first defined the small and medium company and the non-small and medium company. So they have these two categories. So under the small and medium category company, SMC level company, you can say, they have given certain relaxations under different accounting standards. So when we go to the AS 15 part of that relaxation, it says that firstly, in the short-term employee benefit obligation, that non-vesting accumulating leave, like example, we discussed sick leave, which was not encashable, that kind of leave provision is not required for the SMC level company under the AS 15. The second relaxation they give for the SMC level company is regarding the disclosure to notes to account of the post-employment plan. So they say that for this defined benefit obligation like gratuity, etc., you have to do the calculation, make the provision as per actuarial valuation, use these assumptions whatever is prescribed, but the detailed notes to account, which are given under para 120 of the AS 15, there is no relaxation on the provisioning part. Relaxation is given only on the disclosure part of the para 120.
Okay.
But while we move to the index situation, because this is what I was talking regarding the AS 15, but if we move to the index situation, where we have the index 19, there is no such relaxation in any accounting standard. There is no relaxation in the index 19. Company, even if they have 11 employees, their turnover is, let's say, 1 lakh rupees or 1 lakh crore rupees. They have to completely follow the index 19 in its entirety. They need to make the provision. They need to make the disclosure. But in summary, in AS 15, if it is a SMC company, yes, they need to make the provision as per actuarial valuation for this gratuity plan, but disclosure is exempted.
Okay, so in short, we can say all the companies are required to get the actuarial valuation done. It's just that certain disclosures are exempted for small companies in AS 15 regime.
Yes.
But actuarial valuation is required even though there are 5 employees.
Yeah, 5 employees, I would say we need to check whether Gratuity Act is applicable.
Yeah, of course.
Let's say they were earlier had 11, now they move to 5. So now in the lifetime, it will be applicable.
Got it. Right. So that helps. Next question, sir. As you mentioned that projected unit credit method, PUCM, is used, has been adopted by all the accounting standards as a method to calculate the provisions. So can you please help us understand this method a little bit, and also the actuarial assumptions around the entire valuation part?
Yeah, so basically, as I said, this projected unit method, the name only will give the methodology, like it's projected. So what we are doing in this, if I tell you in simple line, it is the expected present value of the future payouts. So what we are doing, we are projecting the cash flows in the future years, that what will be the future payouts. Let's say if the death happens in the next year, what is payout? If employee leaves the organization, what is the payout? If the retirement happens, what is the payout? So first we project the accrued amount. Then we apply the different parameters of the decrement, which is known as the attrition rate and the death rate, to arrive at the expected cash flow. And these expected cash flows, we take the discounting to arrive at the present value. So this net present value is called as a defined benefit obligation. And when we speak on the assumptions part, because under this PUCM method, we need to use certain assumptions. Like first assumption, I spoke about the projection. So to do the projection, we need to have the salary escalation rate. Let's say the benefit is last drawn salary benefit. So we need to apply the salary escalation rate. The another assumption could be the attrition rate, because we spoke about the decrements, that when the benefit will be paid. Because when you leave the organization, when you resign from the company, we take the attrition rate. We also have the death rate. Then we also have the discount rate, because we are doing the discounting of the benefits. So these are the 4 key assumptions in the gratuity type of plan. But let's say if we extend our horizon to other plans, let's say the pension plan. So there we will also have additional assumption of the pension escalation, because the scheme may say pension will increase in the future years, let's say every 2 years, 4 years or so. So that pension escalation will play a role. We can have the post-retirement medical plans, where we can have the medical cost inflation. Then we can have certain plans where we pay the fixed monetary benefit on the lump sum. Like Siddharth sir have described one type of benefit, which was a lump sum benefit on the retirement. So if it is a lump sum benefit, which is a fixed in monetary terms, then this salary escalation and cost escalation will not come into play. So what is the assumption? It will depend on the underlying benefit. That what is the benefit we are paying to the member.
Right.
On that particular benefit, we will consider the assumptions.
Right. So as you said that actuary applies a lot of assumptions while they calculate the benefit, and the companies make provision for that amount. Assumptions can change, right? Every time when they do the valuation, the assumptions will change. So what is the accounting impact of that?
Yeah. So what happens, first of all, is we go to the accounting standards. The accounting standard says assumptions are set by the management. They are the best estimate of the management. But as a stakeholders, we actually and the auditors, we also have the joint responsibility somewhere. Like in actuaries, we have actuarial practice standard. So in that we have actuarial practice standard 27, which is applicable to actuaries, and they are required to ensure that assumptions are reasonable. Similarly, on auditors, as a stakeholder, we have SA 620. So they are also in a way required to ensure the reasonability of the assumptions. Now let's say we have set some assumption, but in the next year there is a change in assumption. So accounting treatment for such change in assumption, it depends. We are in the AS 15 or we are in the Ind AS 19. So in case of AS 15, which is the IGAP old one standard, all type of actuarial gain loss, they will go to the profit and loss account. But when we come to the Ind AS 19, which is the IFRS convergent version, then this actuarial gain loss on the post-employment plans, they will go to the other comprehensive income. But while we do the actuarial valuation for benefits of other long-term, like leave encashment, which we spoke earlier, in that kind of benefit plan, which is other long-term plan, in such plans, actuarial gain loss in the Ind AS will be recognized in the profit and loss statement, and not in the OCI. This is what we have given under the para 154 and 155 under the Ind AS 19. Where for other long-term plan, they have kept the treatment consistent to the AS 15. Like AS 15 also tells you to recognize in the P&L. Ind AS also say you recognize in the P&L. for the actuarial gains and losses for the other long-term plan. But for post-employment plan, the index have specific diversion from the IGAP, which is actuarial gain loss, which is also known as a remeasurement under the other comprehensive income.
Right. So basically it depends now that what type of benefit it is, and then between AS 15 and Ind AS 19 we have to understand that which benefit will go in PNL and which will go in OCI. Right. So, moving on to the accounting parlance, we want to understand the presentation and disclosure requirements of defined benefit obligations and defined contribution plans now. So, Siddharth sir, I would request you to help us understand the difference between these two plans as far as the presentation and disclosure requirements are concerned. So, you're on mute.
I'll start off with the presentation requirement on the face of the balance sheet,
Yeah.
and then I will on the balance sheet rather than the face of the balance sheet, and then I will go into the details of the disclosure requirements.
Sure.
So there's a lot of the standards are not very clear with respect to the presentation requirements for post-employment benefit plans, as well as there's no clear explicit guidance as well as for the other long-term employee benefit plans. So generally, there is a requirement in Ind AS 1 as well as in Ind AS 19, which says that you could do the current versus non. I'm talking more from a non-current versus non-current classification, of these plans. So like leave encashment and gratuity. So for what we are generally seeing, based on the requirement of the standard is for gratuity, there is generally a bifurcation between current and non-current, and that is done through the help of the actuary of what payments are required to be made within the next 12 months. Because the Ind AS 19 and Ind AS 1 to some extent provides that benefit to do that. If you look at Ind AS 1, what it says is there should be an unconditional, if you can put something as non-current, only if there's an unconditional obligation to defer payment beyond 12 months. Only then, standard liability can be presented as non-current. And, we don't know when an employee is likely to leave or when the employee is likely to remain. But Ind AS 19 does provide some leeway read with Ind AS 1, though not explicitly written. The literature given in the large firms, say that, for gratuity and post-employment, you could potentially have a current or non-current classification of your, in the balance sheet. But with respect to other long-term employee benefits, there's no such relaxation given in Ind AS 19 and Ind AS 1. So what we are seeing is many companies present the entire liability as current, assuming that you can take the entire leave within the next 12 months as per the leave policy. If that is possible, then or you're going to be paid cash when you leave the company, then the entire amount is presented as current. Mixed practices are seen, but purely technically, if you go by the standard, leave encashment entirely should be presented as current, while for gratuity, there could be some, relaxation where you can, differentiate that between current versus non-current. Leave encashment, of course, subject to your leave policy that everything will get utilized within the next 12 months, or you can encash it in case you leave within the next 12 months. And you cannot stop an employee from leaving or resigning. So that is as far as the presentation on the balance sheet is concerned. Now we'll go to the more detailed disclosure requirements of employee benefits. So we'll start off with, defined contribution plans. So what you're required to basically present is, the amount of expense that are recognized in a defined contribution plan. It needs to be disclosed separately, in the notes to accounts. You don't need to disclose it on the face of the P&L, but all these disclosures can be given via schedules or disclosures in the notes to accounts. So the amount that is recognized as an expense for any plan would need to be disclosed separately. Defined benefit, there is basically detailed disclosures, and these disclosures, probably run into 3 to 4 pages minimum. And what we generally would see in a disclosure relating to defined benefits is, a reconciliation of the opening and the closing balance of the plan assets and the defined benefit obligations. So you would have the opening balance, then you would have the breakup of the expense, into service cost, the finance cost, actual gain and loss is recognized in OCI, any contributions made, any payments made, and the closing balance of the defined benefit obligation. So the full detailed reconciliation of the opening and closing balance is required to be given. Similarly, the plan asset reconciliation of the opening as well as the closing balance needs to be given. Then the significant actuarial assumptions that are used to determine the defined benefit obligation, including any sensitivity analysis for each significant actuarial assumption, it needs to be given. So the significant assumptions could be the discount rate that has been used to measure the defined benefit liability. It could be the employee attrition rate, etc. So there are various assumptions that are used. So basically the disclosures relating to those assumptions needs to be given over a period of 2 years. Then the contributions that are expected to be paid to the plan for the next annual reporting period. Then the information about the maturity profile of the defined benefit obligation would need to be given, including information about the distribution of the timing of benefit payments and the maturity analysis of the benefit payment. Similarly, you need to give detailed qualitative characteristics of the defined benefit plan. What is the nature of benefits that has been provided, the regulatory framework under which the plan is operated, and also a description of the entity's responsibilities for governance of the plan. So detailed disclosures are required with respect to defined benefits, and more or less the requirements under AS 15 and in AS 19 are similar, though I think in AS 19 requires a little more detailed disclosures.
Right. So thank you, sir, for explaining the presentation and disclosure requirements in such detail. I just got one question that in case of a proprietorship or a partnership, right, these entities would also be having certain gratuity applicability. Then in that case, how the provision works out? Because we understand that in income tax, the expense is allowed on a payment basis, right? And partnerships and for proprietorships, we do not, these entities mostly follow the income tax provision. So how the provision is accounted for in this case?
So basically, the accounts are prepared, in compliance with either Ind AS 19 or AS 15. The regulatory requirement requires you to prepare the financial statements in accordance with, say, Indian GAAP or Ind AS, and therefore, Ind AS 19 or AS 15. Then, you would need to apply the requirements of that standard. The applicability of the accounting standard is also dependent on the level, defined in the DIS 1273. The payment of gratuity is applicable to the proprietorship. It's most likely that the provision for gratuity would also be required. And the treatment of such items for the income tax purpose would not have any bearing on the accounting. I think you would need to, while deferred tax is something which we can need to record for, but I think the provisions of the income tax per se would not have an impact on the accounting.
Right. Yeah.
Now here, what is the main issue? The main issue is that the proprietorships, partnerships, they have a feeling that though they are following accrual system of accounting, but they say gratuity is applicable only after 5 years. And thereafter it is on payment basis as per income tax allowability. So they say a gratuity, they don't make a provision there. They don't make a provision there. They say it is fine and the auditors audit. Now here what is very, very important is that when they're following accrual system of accounting, then leave aside accounting standard. For the accrual concept, they have to make a provision for the gratuity.
Yes.
Very, very important. And we have seen cases, even at the FRRB level, in the case of listed companies, what is happening? That income tax is so much in the minds that in the accounting policy, the company writes that the company is providing for the gratuity only on the payment basis. and not on accrual basis. So they mention that in the accounting policies. They say we have mentioned in the accounting policies that this is the way we make a provision for our long-term employee benefit, that it is on the payment basis. So we have done fine. Now the issue is here, the role of the auditor. Auditor will have to say if that amount is material, then they have to qualify it.
Agree.
And
Right.
they say it is showing a higher profit to the extent of this much amount, they have to calculate and give it.
Agree.
So here the role of the auditor comes, because if the gratuity provision, there is a system of leave encashment, the provision is not made. So all those provisions are required. Merely mentioning in the notes to account will not do. In the case of even companies or even proprietorship, partnership, LLPs,
Agree.
Right.
they forget that gratuity income tax it is on cash basis, so will not provide. So we as a chartered accountant have to be very, very careful.
Agree. Just disclosing on the accounting policies does not mean that you've done your bit. It has to be in compliance with the requirement of the reporting standards, and I think both Indian GAAP and Ind AS is pretty clear that you need to apply the requirements of that standard. So income tax
And
act
not even
yeah.
it is not only standard, also the basic AS1 accrual system.
Yes.
Accrual
Agree.
system, AS to both baad ki baat hai.
Right.
Yes.
Right. And also, I think to add on this, we have accounting standards for non-corporate entities as well. So those also have to be kept in mind by all the partnership firms and proprietorship firms while they account for anything. Right. Yes, sir. Please go ahead.
Yeah, so to add in this, like we discussed the SMC, non-SMC. Under the non-corporate entities, we have level 1, 2, 3, 4. So under the level 4, if you fall, which means turnover less than 10 crore, borrowing less than 2 crore, then you are exempt from the going to actuary. You can do your own calculation if you are under the level 4, but it doesn't stop you from the provision. You have to make the provision, but you don't have to go to actuary. But if you fall under the level 2, level 3, which means turnover beyond 10 crore, turnover below 250 crore, which is combined level 2 and 3, plus you have number of employee less than 50. If these are the two conditions combined met, employee less than 50, level 2 and 3 of the entity, then you don't have to go to actuary. You can make your own provision. Otherwise, in all situations, provision has to be done as per actuarial valuation. The standard further says, in cases where they obtain the exemption, they need to make the provision assuming that all payments are required to be done immediately on the balance sheet date. So technically speaking, as a chartered accountant, let's say we continue with our first example, where you are in the first year of organization, you have rendered only 1 year of service. So if you have done the provision as per actuarial valuation, you had made the provision only 60%, stating that 10% is your per annum chance of attrition. So let's say 40% chance you will not pay because employee will leave the organization. But if you consider that, then whatever is given in the standard, then if you go as per that, then there will be the inconsistency in the provision. So if it is a small organization, it is fine. Number of employee less than 50 and level 2, 3, otherwise the level 4 entity. But otherwise, for the all other entities, they need to do as per the actuarial valuation. Plus provision is mandatory for all, irrespective of size, irrespective of standard.
Right.
And in experience, I have seen a company, 1,000 crore balance sheet company. They approached us for the first time, where previously there was no actuarial valuation provision. All accounts audited. So as an auditor, we have a higher responsibility, as sir told, that we need to ensure that provision is made. Otherwise, qualification is done with the quantification, that this is the impact on our profit. Yeah.
Absolutely.
Yeah, back to Charlie.
Yeah. Thank you so much, sir. Thanks for Pramod sir for giving us an insights on this, and thanks to Siddharth and Kartikeya sir for adding on to this. I think it's to sum it up, we would say that all the entities, be it company, partnership, proprietorship, any entity needs to provide for the defined benefit obligations or defined contribution plans, right? Any gratuity, leave encashment, anything, the provision has to be there. It's just a matter that whether the actuarial valuation is required or not. And as Kartikeya sir has already mentioned, that all the companies required to get the actuarial valuation done. For non-corporate entities, partnerships, proprietorships, basis the level categorization, level 4 companies have some exemptions, but for all other entities, even which are not companies, need to get the actuarial valuation done. So I think as industry, as a part of industry, as a part of employment, as a part of entrepreneur, as being a chartered accountant, as being an auditor, it's our responsibility to ensure that companies have the provision and the actuarial valuation is being done wherever required. Right. So thanks to all for discussing this matter. Now moving on to the next question. To you, Siddharth sir, we want to understand, because in the initiation you mentioned different types of benefits to employees, right? Short-term benefits,
Yep.
post-employment benefits, then other long-term or other post-employment benefits, and then some termination benefits. So what is the difference between post-employment benefits and termination benefits?
Yeah. So, as explained earlier, post-employment benefits are basically benefits that are payable after completion of employment. On the other hand, termination benefits are those benefits that are provided in exchange for termination of an employee's employment, which could be a result of, either the entity's decision to terminate that employment before its normal retirement date, or the employee's decision to accept an offer of benefits in exchange of termination. So that's the basic difference between, post-employment and termination benefits. Termination benefits are generally, paid at time of termination of the employee's services. Generally, post-employment benefits are accrued over the service period. Whenever over the period in which he remains in service and renders the services. However, the obligation for the termination benefit arises from the termination event and not from the employee's services. As a result of this difference in attribution, the obligation for termination benefit is not recognized over the service period, but under a separate requirements for such benefits. Therefore, it is important to distinguish between the termination benefit and post-employment benefit. IAS 19 or Ind AS 19 basically knows two factors which are important, to understand the difference between termination of an employment versus post-employment. The benefit is conditional, as I said, on future services that has been provided, including the benefit increases if future services are provided, and if the benefit is provided in accordance with the terms of the employee benefit plan. And then in that case, it could be, a post-employment benefit.
Right. And to account for these two, is the actuarial valuation required for termination benefits as well?
Termination benefits will depend, how it is determined. If the amount is determined, by a particular formula and is payable immediately, we may not need a actuarial valuation because that is going to be paid immediately. But, if the payment is going to be deferred over a period of time, then potentially you could read actual valuation. But in my experience, I've not really seen companies appointing actuaries to do termination employment. Maybe CA Kartikeya could elaborate a little bit more on whether he has done any actual valuation. For calculations could be complex, and you could probably, because of the calculations, may involve them, but otherwise may not be really required.
Yeah, so in my experience, I have seen one policy under the VRS scheme where what they have done, they are paying the benefit as a series of payment till the lifetime, or let's say fixed period of, let's say 10 years from the retirement. So what happens? First, the principal says you need to book the expense at the time of termination. So expense is recognized as per the actuarial valuation considering present value, probability of death, etc. Then at the every year we need to see how many such members are living, how many have actually died, how much payment is done. So till the time of settlement, that exercise keep on running. Every year charge will be very low because almost full charge is taken in the first year itself. Later on, it will be only actuarial gain loss. So it is very less likely that we will have some kind of actuarial exercise in VRS kind of scheme. This is only one scheme I have experienced in my last 10 years of span.
Right. So, sir, discussing all these schemes which are requiring actuarial valuation, we have heard gratuity and leave encashment as the two most popular kind of benefits which require actuarial valuation. So, what are the other kind of benefits which are maybe common in the industry, but we have not heard about, which require actuarial valuation, and companies do give those benefits to their employees?
Yeah. So, one of such common benefit is the deferred bonus. Like you pay the bonus to employee in the staggered manner. So this requires actuarial valuation as a other long-term plan. Under other long-term plan, we have various other benefits also. Let's say company have a policy of paying gold coin. Once you complete 5-year service, 10-year, 15-year as a milestone, they will pay you the gold coin. So we need to make the provision for the expense of such gold coin as a other long-term benefit on the actuarial valuation basis. Other example is company have a stated policy that if you retire from the company with, let's say, minimum 20 years of service, we will give you a car. So this is a stated policy. So for that also we require to make the provision as per the actuarial valuation. We can't say कि 20 साल बाद जब ये कार दिया तभी खर्चा करेंगे. We have to account for the cost when you render the service.
Right.
The other example is employee loans. Like if you are following the Ind AS and you give any loans to employee at a subsidized rate, let's say market loan rate is 10%, you are giving them loan at 3%. So Ind AS says you account for such loan on the fair value basis. But what will be the second treatment? Because it is given to employee, so we need to account for that expense for such employee loan also, and that will, the expense part will fall under the Ind AS 19. The other kind of employee benefits which requires the actuarial valuation are like post-retirement medical scheme, where we pay the benefits to the employees after the retirement, after service, after death also. So the medical scheme, pension plan is one of the such example where we pay the regular bonus, exempt provident fund, like Siddharth sir explained, because this is one of the error which was found by the Financial Reporting Review Board also, that company have the exempt PF trust, but they are reporting in the financials as a contribution plan. But it is a benefit plan. We need to make the provision as per the actuarial valuation. We can't shy away from the provision part. So these are some of the common benefits. Obviously, there can be some other non-common benefits also, like say phantom stock, which may looks like to be a ESOP, but where underlying benefit is not the equity share, but underlying benefit is something different than the equity. It may be linked to your profit, your revenue, your PAT, XYZ. So such kind of phantom stock plans will also fall under our Ind AS 19.
Right.
Yes,
Thank you
any
so much.
plan you have observed in your auditing that which is maybe different, uncommon plan?
So what I have also seen is, that was a very large group, while there's no legal obligation or no scheme, they make payments, on death of an employee during the employment terms. That also is potentially employee benefit plan, because there is a past practice of the company basically making payments to the kin of the employee when he expires, and those payments were quite substantial for a large group, and that potentially could also be part of the plan, which will require an actuarial valuation to be performed.
Right. So basically, for all the companies which are giving employee benefits which are extending more than 12 months, they need to analyze and evaluate every sort of plan, whether it will attract valuation, actuarial valuation or not. So they are advised to consult their chartered accountants and actuaries whether the benefit will attract actuarial valuation or not. And needless to say that the provision has to be there.
Yeah.
Right.
Similarly,
Just to add in this, there is a expert advisory committee opinion that if company provides any leave travel concession, for example, in the PSU sector, they have the actual policy of paying the LTC benefit. Like in private sector, what happens? We get the LTC only for the tax benefit. Like they are not actually paying you LTC, but it is just part of your salary structure. But in PSU, they actually pay you LTC benefit on the basis of your claims proof in 2 years and 4 year cycle. So there is a ESE opinion that for such LTC payments, also this is a other long-term plan because it is paid beyond 12 months from the reporting date, and we need to make the actuarial valuation. Similarly, sometimes organizations believe that for sick leave, which is carry forwarded in the long term but not encashable, they don't make the provision. But as per the ESE opinion and as per the accounting standard board guideline on the accounting standard, it is very clear that what we described earlier also, that we need to make the provision for such sick leave also.
Right.
Yeah, yes, sir, you were adding.
no, yeah, I was saying that there could be some type of plans, where the payments are made based on, achieving certain targets,
Yes.
like achieving a target of revenue after 5 years. Sometimes, there is also something which is based on EBITDA, sometimes share price. So it is dependent, which standard, it falls into. If it is based on, say, share price, it will most probably fall under the requirements of Ind AS 102. And you will account for it as per Ind AS 102. But if it is not based on share price, and the payments are based on revenue targets, EBITDA targets, etc., and they're payable, say after 1 year, again there will be type of an other long-term employee benefit plan, and will need actual evaluation and an accrual basis of accounting. Again, there are two or three ways you could have. What we have seen is this one plan which is something is payable at the end of 2 years. If you reach a target of, say, 500 rupees at the end of 2 years, if you reach a target of 800 rupees at the end of 3 years, an additional amount is payable. Then at the end of the 5th year, if you reach a target, of revenue, you'll get a payment of, say, 10 rupees. Now, are these one plan? Are these separate plans? How do you account for it? Is it a graded vesting accounting that you need to do, or you consider all of that as one plan and record it? There are a lot of complexities involved in long-term employee benefit plans, especially deferred bonuses plan. So other than, also actual valuation, how to account for it, sometimes you make a large payment towards the end, the 8th year, and smaller payments towards the 5th, 6th, 7th, or 3rd year. So should you account for the 8th year as a separate plan? Should you account all of them as a separate and therefore account it only in the 8th year? Or you start recording each plan as a graded vesting form year 1 and take the charge? Are quite complex, and the guidances given under Ind AS 19 should be looked into, to account for those type of plans.
Very true.
Right. Thank you so much to both of you for explaining and giving us the idea that there can be different types of plans which will require actuarial valuation, and it's not just gratuity and leave encashment. Right. So, yeah. Now, moving on to the next part. Siddharth sir, I have this question for you, that there is an appendix to Ind AS 19. Right, which talks about the limit on defined benefit asset, minimum funding requirements, and all of that. So, if you could just help us understand that.
So, this typically will come, in a situation, when your plan assets are more than your defined benefit obligations. And, then how do you record it? Do you record a net defined benefit plan asset on the balance sheet? So the guidance is regarding that. So what the guidance says is, there is an asset ceiling requirement. So the plan is in a surplus, and the amount recognized as an asset in the financial in the balance sheet is limited to the asset ceiling. So the asset ceiling is basically the present value of the economic benefits that could be available in the form of a refund or a reduction in future contribution. So you can only recognize a plan asset, net plan asset on a balance sheet to the extent that you are entitled to a refund in the future from the trust, which in Indian scenario I believe would be very, very rare, or it is going to be resulting in a reduction in future contribution. So that is the guidance which it states. And then in certain jurisdictions, there's also a minimum funding requirements which is required to be made each year, and it that also impacts whether you record a net defined benefit plan asset or not, or you restrict the amount of net defined benefit, because when you make a contribution to the fund, generally it should not impact your liability because that is determined actuarially. But if there are basically features in the scheme, of the amount of contribution you can make now, amount of contribution you can make in the future, amount of refund that you can make, that will have an impact on the accounting and the amount of net defined benefit plan asset that can be recorded. So basically you can only record the net defined benefit plan asset to the extent that you are entitled to a refund, or that is going to result in a reduction in the future contribution, which is likely to be made in the next few years.
Right. Thanks for explaining that part. So you mentioned plan assets, right? So we also want to understand more on the plan assets, what these exactly are and how the accounting goes for this.
So basically, plan assets are basically which is held by a legal separate fund that is existing purely to make the payments towards the employee benefit obligations. So you cannot use these plan assets for any other purposes. And they are not available, say, for example, to pay the entities creditors, and they generally cannot be returned to the reporting entity unless after making all the employee benefit obligations, etc., and then no other employees left, then if as per the scheme, and as per legal regulations, you are allowed to basically get a refund. So plan assets is basically the assets, the contribution that you make towards the assets to the fund, and then they invest in various basically types of assets. They will invest in fixed deposits, they will probably invest in government bonds, etc. So those are generally considered to be plan assets. Qualifying insurance policies are also considered to be plan assets. You may basically have an employee benefit obligation, and you may basically have an insurance policy with LIC, where LIC will make the payments that arises on the retirement of an employee. The requirement of the standard is basically to fair value all the plan assets. The fair value of the plan assets is deducted from the defined benefit obligation, to determine whether you have a net defined benefit liability or a net defined benefit asset. So generally, what we have seen, the type of plan assets which are held by a fund are, cash will always be a type of plan asset. Government bonds, investment in government bonds, sometimes corporate bonds, equity shares potentially could also be a type of plan assets, though of course a lot of funds would not invest in equity shares considering the risk profile, but the standard at least permits you to invest in equity shares also. Qualifying insurance policies could also be potentially plan asset.
Right. So I think in the standard, it talks about state plans and multi-employer plans as well. So if you could just briefly help us understand this.
Again, not very relevant, at least the multi-employer plan, are not very relevant, in an Indian scenario. We've seen, probably in European countries, etc., where, 4 or 5 employers come together, to pool the assets together, and these entities are not under common control. And then, whenever an employee leaves, the fund where the assets are pooled for these entities makes the payment for the defined benefit obligations. So the accounting for these type of multi-employer plans are similar to how you do for a single employer plan. Firstly, you need to determine whether it is going to be a defined contribution plan or a defined benefit plan. That is the crux. Mainly, generally for multi-employer plans, 9 out of 10 situations, it will be similar to a defined contribution plan. Because what you would do is, you would contribute to this fund. Multiple employers will contribute to these funds, and then they will invest, and then they will make payments to the employees. And your obligation would generally end, once you make the contribution. Potentially, it could also be a defined benefit plan. And then, in that case, complexities are involved, how you determine what is your company share, because there will be 10 companies which is going to, contribute the assets. And then, there could be issues around, data sensitivity, they will not provide data of other employees. How would you determine your share? So very highly complex. I have not seen it in an Indian scenario. And globally also, I have come across 1 or 2 scenarios of this, and they were accounted for as, a defined contribution as per the scheme of the plan. While state plans, they are established by legislation, and basically they cover all entities, which are governed by that particular legislation. And they are accounted for again in the same way like multi-employer plan. You determine whether it's a defined contribution plan or a defined benefit plan. And generally, mostly we have seen that these type of plans are defined contribution plan, and they are accounted for as such because the employer's obligation or the company's obligation ends once the contribution is made as per the relevant legislation to the state plan.
So the companies, they are allowed to offset the asset from this plan asset to the liability.
No. It really depends. Offsetting is only required, as per the requirements of Ind AS 1, which says that you can offset an asset and liability only if you're legally allowed to do so and you intend to do so contractually. So legally and contractually, can you, offset the asset of one plan against a liability of another plan? It would be very, very difficult to have that type of legal enforceability to offset one plan against that of another plan. And your intention will generally be not to net settle. So these would need to be recorded separately. Within the plan, yes, like the plan asset and the plan liability, is always presented net. But if there are 3 or 4 plans, showing if one is net liability position, another is a net asset position, whether you can net that off, I don't think you can do it, because legally the scheme documents will not allow you to do that. And because the scheme documents would not allow you to do that, you would not be allowed as per Ind AS 1 to, offset the assets and the liabilities of these plans.
Right. Thank you so much, sir, for explaining that part. Now I'll move on to Kartikeya, sir, for insurance premium. So as we understand, mostly companies are paying insurance premium for their employees, right? So how this premium part will be accounted for?
Okay, so firstly, we need to understand that whenever we make the payments to the insurance company at the time of when we have the funded plan, so the payment will have 2 parts. One part is towards the contribution, which goes to your fund value. So the fund value will be your plan assets. It is like your asset account, investment account, you can say. So that whatever we contribute, it is your asset. So the one way of accounting is you can create the gratuity asset ledger and you can add the value into that. Other option is you can reduce from your actuarial provision, because at the end of the day, while you prepare the balance sheet, in the balance sheet, we show the net liability, net provision. Let's say you have defined benefit obligation of 100 rupees, plan assets of 60 rupees. So only 40 rupees go in the balance sheet as a current and non-current breakup. So while you contribute the money, we are okay, like it can be shown as a gratuity asset ledger or deduction from the provision ledger. But what comes the premium amount? Sometimes the insurance company charge the explicit premium amount at the time of taking money from you. So such premium is not part of your assets. It is a recurring annual expense. So such additional expense of your premium, it will be recorded as like your staff welfare expense or your insurance premium expense, because while you contribute for the gratuity, the insurance company covers your group term insurance as well. like if the death happens, the future period gratuity they will cover. And for the benefit of our members, as per the IRDA rules, the minimum sum assured required under this kind of policy is 5,000 rupees, but maximum can be the full gratuity if company wants. So as a minimum requirement, because if your sum assured is high, your premium will be high. So while taking any insurance policy, management should take a conscious call that what amount of sum assured they want, whether they want full sum assured or they want only the minimum sum assured, because as per the regulation, there is no requirement to keep the full sum assured for the future death gratuity. It is a voluntary benefit what we are providing to the employees. So that's all from the premium side.
Right. Thank you so much, sir, for explaining the insurance premium in detail. I would like to move to Siddharth, sir, for some income tax related guidance on this. What are the income tax provisions related to these liabilities or accruals that are booking on the employee benefit obligations? And what is the impact of deferred tax? Will there be some deferred tax impact on this?
Yeah, so generally, employee benefit expenses is allowed as a deduction, on a payment basis. Especially the Section 43B type payments. And because of the existence of the deductible temporary difference, there's a difference between the tax base and the book base, and because these payments are only allowable on payment, you would record a DTA with respect to these type of employee benefit obligations.
Right. So I think this is another one very important point to note for all the members, because we tend to miss the deferred tax part of employee benefit obligations.
Yeah.
Right. Right. So also, sir, since now we have ICDS guidance in place, so do we have any different treatment as per ICDS on employee benefits?
To the best of my knowledge, I don't think there's a separate treatment for employee benefits and ICDS. However, the tax impacts are generally, governed by 43B, 40A7, of the Income Tax Act. So those requirements will need to be, of course, complied with, and that will potentially also lead to creation of generally a DTA. So that is what companies will need to look into, and auditors would need to be wary of.
Right. So thank you so much, sir, for explaining the tax part of it. Now, Karthik, sir, we just want to know that if there has been any amendments to the guidance that we have discussed, or is there any change that has been made to the guidance in past 1 year or so?
So actually, there is no amendment being done in both AS 15 and Ind AS 19 for last 1 year. But under the IFRS in IAS 19, they have proposed the amendment in the disclosures to make it more principle based, but that amendment in the disclosure of the IFRS is only at the preliminary stage now. It is not yet finalized. So I can say there is no amendment done in both the standards which is applicable.
Right. And any which ways for all the members, the entire guidance on Ind AS 19, AS 15 and related guidances are available on the website of ASB, right, at the portal. So you can refer the guidance from there. Right. So now that we have discussed the accounting parlance of employee benefit obligations, and we have understood that actually the companies are using the services of actuaries for most part of the employee benefit obligations. So Siddharth, sir, what is the role and responsibility of an auditor from the point of view that company is using the services of actuary?
So basically, the auditors has sole responsibility for the audit opinion, and the responsibility is, not reduced by the use of an expert. They'll still be responsible for, giving an audit opinion, and therefore they will need to perform adequate audit procedures to be able to conclude, that proper work has been carried out, and the employee benefit obligations have been computed properly. This will also include, evaluation of whether the expert is as a necessary competence and capabilities, whether he is independent and is able to perform his task independently, evaluating the uh, basically the competence of the employee. That is something which that is something which would need to be performed and documented well in their audit work papers uh, to be able to demonstrate that the actual valuation has been done as per the requirements of India's 19. One more very important part that they need to look at is, the completeness and the accuracy of the source data that is provided by the actuary. So firstly, whether all the type of employees have been covered. As I said, certain parts, contract employees could also be covered under the requirements of the standard, and therefore, we need to compute the defined benefit liability for contract employees also. So whether you're covering all aspects or all employees required to be covered is one aspect that they need to cover. Then the data sent to the actuary, like, all employees are covered, whether the basic data is calculated properly, uh, and it matches the payroll register. So the completeness of the data sent to the actuary is important. This is something which we have seen that is not being done by many auditors. They just see, they take the actual valuation report and file it, and then just ensure that the numbers from the actual evaluation report agrees to the financial statements, but that is not the only thing that they need to do. They need to do much more, and they also need to test the assumptions. The discount rates that have been used, to compute the defined benefit liability, that needs to be tested. Then basically, the increment rate that has been used to basically compute the defined benefit obligations, that would need to be also tested, basis the past history. What is your past history of increments that you're given, what is management's expectation of future increments that is going to be given. So that needs to be tested and documented well. Similarly, any other assumptions, that about death rates, etc., would also need to be determined. The fair value is being determined. What are the assumptions used to determine the fair value of the plan assets? Those are the things which will need to be tested. Many places, we have seen that auditors also use their internal experts, who
Okay.
have the necessary competence to evaluate the work of the actuary. So that is something also, you could potentially use. But just by using even an internal expert doesn't mean that your work as an auditor or the audit partner is complete. You will also need to assess the competence of the internal expert also as per the requirements of the auditing standard. uh, Ensure that proper disclosures are given. The disclosure requirements, as I said earlier, of India's 19 are quite significant and quite voluminous. So while they actually gives all the disclosures, ensure that they are properly given and reflected in the financial statements.
Right. Thank you so much, sir, for explaining that in detail. Karthik sir, I have one question for you. Since you're wearing two caps at the same time, being an actuary and a CA, so do you think that from a CA point of view, are we capable of challenging the computations done by actuary, or do we, challenge the actuarial assumptions?
Yeah, so I would say we should challenge. The reason is, see, we can somehow check the assumptions by observation also. For example, you see the actuarial report where, let's say, the attrition rate assumption is considered as 1% to 3% per annum, and you are doing the full audit of the company. So as an auditor, you know that yes, every year at least 10 to 15% employee leave the company. So how the attrition rate is 1 to 3%. So without doing much of the analysis also, you can raise the question on the assumption. Similarly, on the salary escalation rate, that salary escalation, let's say they are taking 4 or 5%, but you have payroll register. While doing the payroll testing, we found that average increment is 10% consistently. So why they are taking 4 or 5% assumption? And one more important number I will tell you, to cross-check all these numbers. In all the actuarial reports, they give actuarial gain or loss due to experience adjustment. So this experience adjustment is nothing but your variance analysis in one word. So variance analysis, what is variance analysis? Last year क्या हुआ था, इस साल क्या हुआ है, क्या सोचा था, क्या हुआ है. So that's what is our variance analysis.
Okay.
So if variance analysis is very high, that actuarial gain loss due to experience is very high, either in positive or negative, then it is a time to ask your client and your actuary to revisit the assumption. It may be possible that this is a one of the year where there is an exceptional situation which they don't foresee to happen in the future year. Then they can continue with the assumption. But otherwise, if we have a reason to believe to change the assumption, then we should challenge the assumption. As I said, it is a combined responsibility. Firstly, management is responsible as given under the accounting standard as a best estimate assumption. At the same time, actuary is responsible under the actuarial practice standard, and now under the standard on auditing, the auditor is also responsible. So it is a combined responsibility of all three stakeholders. And to add on this, recently the quality review board in the ICAI, they have come up with one booklet on the issues which they have found. And one of the issue which was found under the SA620 was regarding the checking of the qualification completeness of the actuary and regarding the checking of the reasonableness of the assumption. So on the part of the competency and the capability, I would like to say from our institute side, as an Institute of Actuaries of India, we issue the fellowship qualification and the certificate of practice. So as an auditor, they can ask for the certificate of practice, and also similar to CA Act, the companies are not allowed to practice. So these are kind of some things as a capabilities and competencies we can check for the actuary who is working. And on the Actuaries Institute website, they have given the list of the COP holders as well. So one can either check directly in the list or they can call for the certificate of practice.
Right. Thank you so much, sir, for the invaluable advice that you have given, because I think at times we are not really challenging the work done by actuaries and we are just accepting the report as is. And the one thing that you've mentioned is the actuarial gain or loss due to experience. I think that is one thing we can really keep an eye on. Thank you so much for that. I think I would request Pramod, sir, if there is something to add on in the entire discussion.
Yes, in fact, the discussions have been really very fruitful. Let us just see and take a few questions, not all, of course.
Yeah.
Just 1 second. One question is from Deepak Batuda ji. Is it necessary to match actuarial data with LIC funding details?
Okay, so if I take up this question, the data which is sent to the LIC for their funding purpose, it may be a mid-term data, like not the necessary the balance sheet data. Secondly, as per the income tax rules, if we have any director having more than 5% shareholding, they will not be part of the funding. So while you send the data to the LIC, that will not include your directors. The cutoff date will be different. Secondly, the assumptions which LIC take for the funding valuation, they are totally different than the provision valuation, because they have the fixed set of assumption. If you see 100 LIC statement, you will see the same assumption of 1 to 3% attrition rate. But this assumption has to be the company specific assumption. And further, when LIC give some reconciliation table, they mention that it is not the AS15 report. So that's why due to these things, we don't have to match or don't have to consider the LIC statement as a provision report for the AS15 or the Ind AS 19.
Very interesting point pointed out by Karthikeya ji. Now let us assume a very, very simple case, what I'm trying to understand and putting it into figures. Now suppose a company is having a defined benefit plan, what's LIC gratuity, right? And say at the end of the year, say, because the payments to the LIC gratuity funds are not made at the end of the year, maybe January, February, something like that, they have made the payment. And suppose the LIC had its through its assumptions, as say that they take it common for most of the parties. They said the total payment to be made is say 1 crore rupees, and the company pays it, say in the month of February. And if the company provides the same into the financial statements that this is the gratuity due, the provision to be made as per the LIC policy, I would say their evaluation, it may not be correct because they have made up to a certain point and the assumptions that rightly pointed out. So when the actuarial will make a it's give its valuation for the long-term employee benefit, it could be 1.25 crores or 75 lakhs. It could be different. So accordingly, the provisions should be made in the books of accounts. What I feel so. There could be different.
Yes.
And under income tax again, under the income tax again, I will tell because the payment which is to be now is, let us take the case where the payment has been made of 1 crores and the provision is required for 1.25 crores. So under section 40A7 of the Income Tax Act, the gratuity is allowed on a payment basis, but yes, 43B, we say that under the defined benefit plans, if the payment is made to the gratuity fund, that expenditure is allowed. So the provision would be made of 1.25 crores, but the expenditure would be allowed, would be only 1 crore rupees. So that has to be, the difference could be there. So that is there. We are just closing time, so let us take one or two more questions. One question is from Govindarajan ji. They say, if a non-corporate SSE do not comply with employee benefits such like ESI and PF Act, then what is the role in this regard?
So from actuarial side, there is no penalty in this, but from auditing and labor law side, definitely there will be heavy penalties. There can be prosecution, etc. So, and definitely on the PF now we have the due date rule also. If you don't pay the contribution before the due date, then that will be never allowed. So
no, Kartikeya said that they don't have got a registration for the SIPF.
Yeah.
So date to bhuli jaiye na.
Auditor has responsibility to ensure compliance with laws and regulations, and this will surely be a matter which will have to be reported, and possibly if very material also qualified. So
very rightly, very rightly pointed out that of course non-compliance of the law is there, and if it is material, then of course related you have to qualify as per SA 705. That has to be. A question from CA Gopal Subramanian ji, that during COVID-19 period we saw mass layoffs and terminations of staff of the companies. To what extent has the actuarial assumptions made and provisions created in the year and in the year end that has been accurate against the actual payout scenario of the negative scenario? Kartikeya ji, aapke liye question.
Yeah. So what happens in the COVID scenario? The actual layoff was high. So while we make the assumptions, see, you can't change the assumption of the previous period. You can't change the previous financial statement before COVID. Okay. So we are preparing the financial statements of the current year. Payout will be actual payout. But while making the closing liability provision, we need to ask ourselves whether the current year's attrition rate of, let's say, 50%, whether the 50% attrition will happen again in the next year, or it will be normal 10% per annum, let's say. So while making the assumption, it needs to be allowed. But let's say the second situation, that you are in the month of the April, and in the April that yes, the layoffs are going to happen in the month of May, etc., then you should allow that in your assumption, because assumptions can be short-term plus long-term as a combination. Assumptions overall are the long-term assumption, but we can break the assumption. Like for example, next 1 year or 2 year, the increment will be, let's say, 15%, or let's say attrition will be 30%. But in the future long term, it is the smooth number where the regular based on the long term expectation. So we can have mix of the short term plus long term, but at the same time, payment will be based on the actual numbers.
Okay. Great.
And you also need to see termination payments, especially if there are layoffs, and you're making it payments, when the employee leaves, they are properly accounted in the proper period and computed correctly also on account of these layoffs.
Okay. Great. There is an interesting question from Aparna Prakashji, that can a company restrict the gratuity provision up to 20 lakhs since over and above the amount is taxable in the hands of the employees?
Yes, so actually this point we have covered, like let's say if the gratuity calculation formula 15 by 26, it gives you a value of 30 lakhs because employee is a higher salaried employee. So Gratuity Act says the restriction to pay is only 20 lakhs. So company is not statutory liable to pay 30 lakhs. They are liable to pay only 20 lakhs. But at the same time, Gratuity Act have a provision under the section 4, subsection 5, which says that if employee have the arrangement to pay the higher benefits, in such scenario, they are liable to pay full amount. And as an accountant and as an auditor, we need to ensure that provision is made for full 30 lakhs. Because it is taxable or not, it is a different matter. Because tax will be deducted out of the remuneration of the employee. So as a provision, we have to make full provision of 30 lakhs if we are liable to pay full 30 lakhs if we have the arrangement with the employee. Otherwise, as a normal plain vanilla case, it will be provision based on 20 lakhs.
Okay. Good. Great clarification. Yatish Kumarji's question is that client has not done the actuarial valuation, however, provided the provision based on the internal provision basis. As an auditor, should I modify irrespective of the materiality?
Yeah. Materiality, I think, will of course be important in determining what you need to qualify and what you do not need to qualify. But yes, not doing an actual valuation would be surely not a compliance with the requirements of the standard, and it should at least when an auditor prepares the financial statement, does the audit, there's also a summary of unadjusted audit differences, so he is required to compute what could be the liability as per the actual valuation, or require the management to determine, or alternately determine through other means what could be the liability if you were to do an actual valuation. And if that amount is significant, because how would you compute, how do you know what is the difference unless you actually do an actual valuation? So if you're able to do that and say that it's clearly below the trivial threshold, which auditors calculate, that it's not going to impact the user of financial statements, then it's fine. But if the impact is likely to impact the users of the financial statements, then I think appropriate reporting would be required as per the relevant auditing standard.
And very rightly pointed out, Iyer sir, and just to add into it, very rightly, materiality concept. Depending upon that, the qualification would be there. But another thing is, my audit report, one of the assurance opinion which I give is that the accounting standards are complied with. Yeah. So there mention other than the AS 15 and what is the non-compliance. Point number one. Point number two, even the management, the responsibility of compliance of the accounting standards of the management. And Companies Act provides that if the company is not complying with accounting standards, they have to give the non-compliance, they have to give the reasons for the deviation and the impact thereof in their financial statements. So notes to accounts will also state that. Yeah. So notes to accounts plus audit report. So that has to be very, very clear. The reason management will have to give in the notes to accounts, na?
Yeah.
So they have to give that why they did not get the actuarial done. They did not find one or could not afford one. That depends upon the. I'm on a very later side. I'm just saying that, but yes, the reason has to be given by the manager. Friends, we are now on the closing stages. I'll request Chandni ji to please close. And in fact, many still questions are there, and members are really very, very happy that they have appreciated the program very, very much. The interactive way which you have all discussed. I really thank both the panelists, Iyer sir and Kandoi ji, and Chandni for conducting it very, very well, very, very well. And of course, our secretariat, Shalini ji and Kulushekhar Shekhar ji, for providing the necessary inputs always. Thank you, and all the participants for joining and asking questions and remaining hooked up. Thank you, each and everyone. Thank you.
Thank you so much, sir. Thank you.
Thank you, sir.
Thank you.
Thank you.